Welcome back to the Climate and Sustainability Risk Series. I'm Chair, and in this episode, we will explore one of the most critical topics in sustainability and finance, that climate change risk. So, what it means, how it can be measured, and how it impacts on the company's economics and varies the people. Climate risk refers to the potential negative impacts that climate change can have on businesses, governments, and various societies. So, both today and in the future as well. So, this risk can disrupt various operations in the companies, destroy various infrastructures, shift to the markets, and erode various financial value. So, and importantly, its climate risk is also financial risk. So here you can see the burning forest, flooded city, falling stock charts, and other stuff, different visuals. It's effect of the climate change. So there are two main types of climate-related risk, which is physical risk that caused by the actual climate hazard like floods, storms, heat waves, and sea level rise. And second is the transition risk. So that can come from various shift towards low carbon economy. So Europe has done lots of new regulations that shifting to the consumer demands or the emerging various clean technologies based on the various ESG regulations and the climate regulations. Both type of risk can affect various asset values, business models, supply chain, and labor markets as well. So here you can see the different sides of physical risk and the transition risk, where storm floods are part of the physical risk, and carbon policy or the news headlines or any kind of policy changes is part of the transition risk. Now let's understand the physical risk that comes into the two forms. One is acute risk, that is short-term extreme events like hurricanes or the wildfires, and second is a form of chronic risk. So that is long-term and slower moving changes like temperature rising or the droughts that are working on year by year. So those kind of changes are part of the chronic risk. So whether a hazard becomes a disaster, that depends on various things. The top three things are the hazards or the driver, which can be the heat waves. Second, that is exposures, who or what is in harm's way. And the third is vulnerability. So how this vulnerability or the susceptible they are to harm. So these three things is very important to assess the climate risk, whether these factors can be come together to determine the risk intensity, and we can calculate various climate risk metrics that are required to do a financial assessment. So this risk triangle of hazard, exposures, and vulnerability is very important to calculate the climate risk. And there are two types of things, that is chronic and acute risk, so that you can understand what type of risk is coming up for your company. But the modeling physical risk is very challenging, and climate models involves various uncertainty to assess the climate risk assessment and what could happen for the various variabilities, how it change over the time, what scenarios that we can use, what are the accuracies, how close models are to the real world observations, what are the approach for the various types of sectors. So this kind of factors is very important to calculate the climate risk assessment, and it is very much complicated process. So to understand the basic, to understand through the various analysis is very important to integrate the climate risk into the financial risk. We already seen the physical risk types and what are the things that are important for the physical risk, and to understand how it's work. So let's understand transition risk, which is emerging as the world shift towards the net zero and the low carbon economy. So that covers policy risk. For example, carbon taxes, new regulations are coming up. Second is market risk, for example, falling demand of the fossil fuels, petrol, diesels, and various other traditional fuels. So uh, there are so many of sustainable fuels is coming up, so there is a market risk as well. Third is technology risk, for example, disruptive of the clean energy tech, and there are so many of technologies coming up like carbon captures, battery energy storage systems. So those are the technology risk in the market. Uh, Reputation risk is also one of the transition risks. So being labeled as a climate laggard, and if you committed as a climate positive, or you are committed for the net zero, then you should take the actions accordingly. So these shifts can make certain assets like coal plants or diesel cars that are going to be a stranded asset, that can be the absolute. So this all are known as a stranded asset, and it is embedded things that needs to be done for the transition risk. So here you can see the various stranded label for the various coal plant, diesel cars, and other stuff. And it is not just for the infrastructure. Transition risk also affect on the business models, operations, workforce, and capital allocations decision that are into the financial services. As we discuss, it's not only the physical assets that are at risk. There is a human capital can also be that stranded. So workers in carbon intensive industry may lose their job if we don't manage them, and that is also one of the transition equitably, so that we can use those risk as a transition comes into our operations. So this is where the idea of the just transitions comes in, to ensure that climate action support all the livelihoods, all the parts of people, and retraining and regional equity that are available. So that is concept of the just transition, so that whatever standard asset is coming up, we can do some training for those livelihoods who are part of the oil and gas sectors, or the coal, or the manufacturing sectors, which is a high energy intensive sector. So, for just transition, climate justice, that means making sure no one is left behind. So, for the high intensive industries, we should give the training that is low carbon emissions related training to all the workers who are working in coal, giving the retraining program, giving the clean energy jobs, and how green jobs can be worked for them whole livelihoods, who worked in the high energy intensive sector, that is oil and gas, or the coal and the plant. So just transition is one of the good concept for the climate justice, and you should understand how it's work for the big large industries as well as the small medium enterprises to give the trainings to the existing worker. So ultimately, the question is, how does climate risk affect finance and the broader economy? As we are here for understand the climate change risk, so it can hit various asset values, as I mentioned earlier. It can be hit on the portfolio risk that are investable, impact on the insurance liabilities and the premiums. So premiums can be higher. Disrupt various supply chain and operations from the beginning to the end, influence various credit rating agency that shift to the consumer demand, and how it's work for the various understanding of the various credit rating industries, and they shift to the consumer demand whether they are taking ESG ratings in seriously or not. So, what are the different sectors that are most at risk? That is energy, agriculture, real estate, transportations, and insurance. Apart from this, other sectors is also part of the risk, but these sectors are very much at most high risk. So, but this risk is not just about the downside; it also creates the various opportunities that call as a climate risk opportunity. So, investing in the renewable energy technology, developing resilient infrastructures into the urban infrastructures or the rural infrastructure, creating various green jobs, leading in sustainable innovations. Nowadays, countries and local communities are creating low carbon economy, net zero investment, so they can create more green jobs in their whole country. So here you can see the sectoral risk upside opportunities overlay, so that they can give the enhanced sectors opportunities to people who wanted to walk in this green sustainability, ESG, and the climate profession. So in that manner, there are so many of climate opportunity, so that we can divert our risk into the opportunity. So finally, climate change risk is multidimensional. It's physical,